What can you deduct in your author business, and what even is a tax deduction? What does that mean? I'm Seth Morse. I'm a CPA. I help authors earn higher profits, pay less taxes, and write more books. And in this little baby YouTube channel that's just starting out, it's just learning to crawl, we are answering the questions that you should be asking if you don't know what questions you should have. So if you want a list of what those questions are, there's a link in the description that's going to take you to our newsletter where you can grab that PDF. If you want to look back at the other videos we've done, you'll see that this is a very young YouTube channel. I'm trying to learn how to do this. So every video, I'm trying something a little bit differently to see how things improve. In this video, I'm going to try to be way less scripted and way more conversational. It's going to be less edited, maybe just me kind of talking like this. Let me know which one you prefer, which one's more helpful. This video specifically, we're going to talk about tax deductions, what it means, and what you can deduct in your author business. First off, what is a tax deduction? What does it even mean? Whenever you make money from a business, or really from any source, but let's say just from a business, you pay taxes on that. That's considered taxable income, unless if it's specifically excluded in the tax code. If you make $100,000 from your author business, you're going to add $100,000 to your tax return and pay taxes on that, whatever your tax rate is. Let's say your personal tax rate is 20%. And the way that tax rates are applied is not straightforward like I'm about to describe, but this is just for illustrative purposes. You make $100,000 from your author business and you're in the 20% tax bracket. You'll pay, pretending that this is how it works, $20,000 in taxes. On top of that, you'll have 15% self-employment tax if you're not an S Corp. Let's call it 35%. Top of that, you might have 5%, let's say, of state taxes. And so 40% of income paid in taxes across the board. This is for US-based taxpayers. This isn't for anything out of the country. 40% of your income goes to taxes. That's $40,000 if you made $100,000. But if you had deductions, what a deduction does is it reduces the amount of income that you're taxed on. So instead of paying taxes on $100,000 of income, if you had, let's say, $20,000 of deductions, you'd pay taxes on $80,000. So instead of paying 40% of $100,000, you'd pay 40% of $80,000, which is $32,000. Why is this so hard to multiply by 8? Anyway, so another way you can do this, if you want to know what's the tax value of a deduction, instead of having to calculate it before the deduction and then calculate it after the deduction, just take your tax rate times the deduction. So in this example, instead of saying what's 40% of 100,000 and what's 40% of 80,000, let's just say what's 40% of the $20,000 deduction, and you're going to come up with that same difference between paying $40,000 in taxes and paying $32,000 in taxes. You'll come up with that same $8,000 difference if you take 40% times 20,000. So that's a tax deduction. It just reduces the amount of income that you're taxed on. So keep in mind, if you're spending money on something that you don't need, you still wasted 60% of your money if you're in the 40% bracket. Like you just spent money for something you didn't need to get a tax deduction. You're still out of pocket. That doesn't make sense. That's why we never recommend spending money on something that you wouldn't have bought anyway, just for a tax deduction. It doesn't make sense. Instead, what we like to do is say, what were you going to do to grow your business, and how can we structure those transactions and time those transactions in a way that give you the best tax benefit? All right, we'll have another video maybe on tax planning another time. That'd be a good topic. So what can be deductible? Anything that is ordinary and necessary in the course of business. You'll see a lot of these tax influencers, and yeah, that's the thing. Tax influencers talking about Section 162A and how it's like this big loophole and allows you to write off all these things as a business expense, when all 162A says is you can deduct anything that's ordinary and necessary in the course of business. The IRS thinks that the words ordinary and necessary are really important words, and you don't get to decide what's ordinary and necessary. They tell us what's ordinary and necessary. Court cases tell us what's ordinary and necessary. So no, you can't just say, well, I was really stressed out after a long writing session, and so I needed to go to the spa and get a massage. It's necessary for me to be able to be in that mindset to be able to write a book. The IRS doesn't care what you think is necessary, right? So that would not be an ordinary necessary business expense. Anything that is personal in nature that you get personal benefit from is immediately not a business expense, even if it would otherwise have been a business expense. My favorite example of this, and it's my favorite court case, and I don't know if everybody has a favorite tax court case, but this is mine. In one tax court case, an author, he was writing a book, and in the book, the characters went to a brothel. And so this author said he needed that experience to be able to put it in the book. So he went to Nevada and he frequented a legal brothel, and he took copious notes. He took notes on the interviews, on the clothes that they wore, on the negotiation process, on how much things cost, everything. He even had notes to show this conversation ended up influencing this part of the book, and this character or person that I talked to ended up being this character in the book. He had all that. So he tried to deduct travel and research expenses. IRS disallowed it and went to court. The court actually said he could deduct the travel expenses because they agreed that it was actually research. It was legitimate. It would have been covered under 162A as ordinary and necessary business expenses. What they disallowed was his payments to the brothel. They said that they were so personal in nature that they fell outside of the scope of 162A and they no longer were business expenses for those payments to the brothel. So if you were writing a book and you're wanting to do research for something in the book, let's say you're putting a skydiving scene in the book. If you wanted to take a trip somewhere and talk to like a world-renowned skydiver or somebody who does this and just get their firsthand account of what it's like, the feelings, the anticipation, the emotions, and everything else, to be able to have that context to put in a book, I would say all that is probably deductible because you didn't get anything personal from that. You didn't actually do anything other than gather information to put it in the book. On the other hand, if you went on that same trip and you actually went skydiving, in order for you to feel the thing, for you to put it in the book, probably a great idea for writing purposes, not going to be deductible for tax purposes. The IRS would say that any payments you made for the skydiving itself, you got something in return for that already. You got that personal experience or whatever. And so not deductible as a business expense. All the other expenses surrounding the trip over there, the travel, lodging, things like that, could possibly be deductible, but I would say the skydiving itself would not be. So what is deductible in your author business is going to depend on your specific situation, but in general, any software that you're using to write books, any editing expenses that you pay, any cover designers any kind of supplies that you buy specifically for your author business, like if you buy a computer for doing your writing and you wouldn't have had that computer otherwise, that could be a business expense. Any professional fees you pay in relation to your author business, if you pay an attorney to set up an LLC, if you pay a CPA to help you with your taxes or to help you with your business, that's all deductible expenses. If it's something that you wouldn't have paid for otherwise without your business, and it doesn't fall out of that personal in nature thing and it's ordinary and necessary, you could deduct in your business. There are other things that you may already be paying for that you could possibly still deduct on your business. For example, home office deduction. There's a couple different ways to deduct a home office. Those are expenses you're typically already paying, but the IRS does have prescribed ways of deducting home office expenses on your business tax return. I'm going to do a whole other video on home office expenses because that can get detailed. Same thing with mileage. Same thing with other expenses that you may be paying for personally that turn into business expenses. But there's usually very specific ways of deducting those expenses. It's not just whatever you feel like doing. So I hope that was helpful. I don't know if you liked this format, more conversational, less scripted. Let me know in the comments. And if there's any other topics you'd like me to cover, let me know. See you next time.